Welcome to the Making Money in Multifamily show, where we discuss everything to do with multifamily real estate investing. We believe it's the best way to gain financial freedom and build lasting wealth. This is where you'll find the best information and practices to help you succeed in your real estate business, whether you're already experienced or just starting out. Here's your host, Dave Morja.
Hello, listener, and welcome to the show. I'm your host, Dave Morja, and with me today is Chris Grant. Just for the listener, Chris is the founder and CEO of Evolve Equity. He has personally over a decade's worth of experience in real estate, with his background before that as a production manager in the aerospace field, where he has another decade of experience. Him and his wife, Chelsey, who actually heads the investor relations for the team, they live in Arizona and focus investing primarily in Arizona with their last deal in Phoenix. And Chris mentioned his superpower. I like to ask that for the guests before the show, just so we can have a little bit of a niche to get into. His deal analysis and review for their deals, their LP deals, and the broker deals that he gets sent. So yeah, Chris, really appreciate you coming on the show. I know we've talked a lot in the past, kind of a lot of good stuff going on for you guys in Arizona. So really appreciate you joining me today.
Yeah, Dave, I really appreciate you having me on the show. It's always great to chat with the fellow investors and kind of go through the details of deals and, the market in general.
Yeah, so I guess we can maybe just lean into the deal analysis and see where it gets us. Maybe we'll, drop a specific deal that you guys just exited out of as we go along. But yeah, deal analysis, deal flow, all these things. It's a market where it's probably, looking at 200-300 deals, maybe even depending on the market at this point. So how do you guys manage that? What pipelines do you have? Maybe just kind of give us a brief overview to start.
Yeah, so we have various pipelines that we're looking at to get deal review. So you had previously mentioned, we purchase deals for ourselves, we syndicate deals, but we also passively invest in other deals we see. So what that does is we get a lot of deal flow from not just the markets we're looking in, but markets across the country. So those are a couple different avenues that we have. So within those, networking with other people who are syndicating deals is a good way to, partner with them, but also passively invest. And then finding our own deals, we have some, campaigns that we do direct to seller where we'll reach out to owners directly that fit our criteria, and try to build a relationship there to source deals. And then obviously going through brokers, the more traditional route is another way that we kind of get deal flow.
So we could probably start a bunch of different ways. To me, there's a lot of different channels, and with different channels comes kind of different data to pick apart deals. You mentioned, broker-led deals or maybe even a sponsor-led deal where you're actively investing. That to me is more of looking at a pitch deck, whether it's the broker pitch deck or the sponsor pitch deck. Kind of a little cleaner, a little bit nicer to look at things, a lot more organized. Then you got like the complete opposite end is the off-market stuff where you're looking at very raw data a lot of times, talking to very local sellers and trying to pick apart what's really going on. So how do you kind of transition between the two? How do you make sure you're time efficient? And maybe we'll just start with the pitch deck side of things, whether it be the brokers or the LP where you're investing passively. How do you kind of start with those types of deals where you're picking apart maybe a memorandum?
Yeah, and that's a really good point, because there are different levels of detail, especially on deal analysis, right? If you're getting deal flow, you're not going to get into this deep dive on underwriting, especially in today's market, right? Where, most deals are grossly overpriced and, you're passing on a lot of them on the surface. So really, whether it's us underwriting our own deals internally or us evaluating LP opportunities or other GP opportunities, everything comes down to validation of facts, right? So underwriting is really just validating facts, whether it's cap rates, whether it's rental growth, whether it's target rents, expenses. So really we start at a very high level and we pull from various data sources on how do we validate facts that are being used in a broker OM, facts that are being used in another syndicator's OM, or maybe even our own deal structure. It's all very similar. So yeah, we start with, various sources such as CoStar. If we feel like it's a deal that's, potentially worth pursuing, we'll look at data in CoStar to kind of look at historical trends for rent, cap rates, other metrics like that maybe aren't just readily available online and easy to digest. And why that's important is because if we're looking nationally, right, every market is just so different, right? So here in the Phoenix market, if you buy something at like a four cap, right, you're probably doing pretty good, right? But if you buy that in the Midwest, it's probably a horrible deal. So if you're looking at, and that's going to depend too if it's a value add. There's a lot that goes into that, but just in general, every market's different, right? So understanding what's going on in the market now and then historically and applying that to your deal evaluation is so important, right? For example, exiting an exit cap rate is the very first thing I'll look at outside of just looking at the general area for crime and income, the basic metrics to see if it's even an area that I want to be in, not like a D class war zone type of area. And if it gets to that point, if I'm evaluating someone else's deal, I start just looking at assumption, very high level assumptions. And I'll say, okay, so what are we planning on exiting at for a cap rate, right? Because we all know that deals or valuations of a property are based on NOI and cap rate, right? So it's a very simple equation. But in that equation, NOI has a lot packed into it, right? We have income, we have expenses, we have rental growth, we have all these other variables. It's going to take some time to verify those, but cap rate is one variable that we can get into and validate right off the gate, right out of the gate, right? So that's the first thing I start with. I start with the path of least resistance, right? So if I pull up like a CoStar report for a particular property, whether it's my own, brokers, or someone else's, what I'm looking for is what's been going on in the market historically for cap rate and where does CoStar aggregate that data to say that market is for that type of asset right now, right? So to give a simple example, if I'm looking at a pitch deck from someone else or evaluating my own deals, and a stabilized asset in that market is trading for like a 4.5 cap, right? We know that when we exit, we want to be more conservative for our investors and for our own underwriting. So we're going to exit at a higher cap rate, right? So if we go in there and like, again, let's say the cap rate in that submarket's 4.5% right now, right? So we'd expect if we're doing a 5-year hold, at a minimum, we'd exit at like a 5 cap, maybe a 5.5 with where we're at with interest rates and some of the variables going on in the market right now. That's just adjusting for risk. But if you pull up a pitch deck and what's going on in the submarket is 4.5, and they're exiting at like a 4, and then you start saying, okay, well, something's a little off here, and then you just ask, right? Because you just want to understand where these numbers coming from, because we're just fact finding right now. We're just verifying, validating facts. Um, and when you hear things like, okay, well, so and so's boots on the ground, or we just kind of know the market, that kind of stuff's not good enough, right? Because we're validating facts based on data.
Give me some basis, yeah.
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 And so it's all just like this churn of evaluation, right? And of course, when you see like a red flag or something that's really good, right? Let's say they're really conservative on the exit. Well, that gives me a little bit of confidence going to the next level that, okay, they checked this box and, I feel pretty good about where we're starting. If I see an immediate red flag right out of the gate, it's, I'm going to be pretty critical from that point forward, just because, cap rate has such a dramatic effect on the returns, the deal. So, and especially when depending on the response that you get, right? If it's not a very data driven response, it's going to make you kind of wonder what else is kind of, what they're winging on the rest of the underwriting, or even this is all goes for my own underwriting too, right? Like I want to validate facts in my own underwriting to make sure that I'm using data to guide it. So yeah, that's how we validate like cap rates to start out. Of course, the next step would be if that's, green check mark, I'll dive into the NOI. And I don't know how much we want to get into detail on that, but there's a lot of metrics that you can really look at there. But I guess at a high level, it really just comes down to fact finding, right? And validating assumptions. Because really when you're projecting out into the future on a P&L or you're underwriting, you're having assumptions and you want those assumptions to be backed by data, right? Not just emotion or opinions.
Yeah, it's you couldn't have said it better. It's validating assumptions, and when you're looking at someone else's data, their underwriting, whatever you're looking at the time, it has to be, you have to have the mindset that the risk is mitigated at nearly every channel that you're looking at. Whether you're talking about the cap rate, the exit cap, whether you're talking about the rents, all that has to be mitigated because, like you said, it's a projection. So you have to really be careful to not be putting the best case scenario because if you do that, then your sensitivity is just way off the charts, and you have to basically execute a perfect business plan to even make money for anybody that's getting a deal, and that's just you never want to overpromise and underdeliver. That's just about the worst thing you could do in handling someone else's money. So yeah, great things to keep in mind. And Chris, you mentioned exit caps, and we had spoken before rules of thumb, and the risks involved in that. So I'd love to touch on that a little bit. You mentioned, on this little example here, a reversion in cap rate on an exit, which is definitely risky. But a common thing thrown around, just as a kind of slap it against the wall, is maybe like a 10 bips or 15 bips every year increase. So basically, you take it, 15 percentage points. And then you exit, if it was a 5-year hold, you would exit 50 percentage points over your original cap rate. I just can't emphasize enough that to me, and I know you agree with me, that's just a crazy assumption to make. And maybe that's where you start some underwriting, but it can't be where you end it. So do you want to just touch on that for a minute?
Yeah, and I think you'd already kind of pinpointed it down, right? Like if you think about it, everything in life is about risk mitigation, whether we're talking about underwriting and just life in general, right? So, yeah, I think as far as the cap rate goes, there's a lot of rules of thumb being tossed around out there right now. We live in a big country, though, right? We know every market's so different. I had mentioned like the difference between like a cap rate in Phoenix versus the cap rate in the Midwest, right? So a good example of that would be, let's say I'm looking at something in a low growth, maybe even a negative growth market in the Midwest, right? You know, you would adjust, your assumption would be your risk adjusted returns. You would expect higher cash flow and less maybe equity upside on the exit, because that's adjusting for your risk, right? So maybe you hear someone say, okay, a cap rate, we're going to exit at a 7 cap, right? And it makes you feel really good because you're like, oh my gosh, a 7 cap, that's fantastic. I'm used to these low cap rates in Phoenix or other hot markets. But until you really validate that data, maybe a 7 cap isn't enough. Maybe that market's at a 7 cap right now. So that's just an example of like, looking at stuff in too much of a macro view or too much in general is not good, right? And that applies to you. You had mentioned some rules of thumb, so just tag on a couple more rules of
Hit
thumb,
them, hit
right?
them.
I think on the underwriting, some people really like to look at, okay, I'm just going to use like 3% annually, just like a flat, that's what we're going to use because that's what everyone else uses, right? Again, different. I'm not saying one is bad or one's good, right? But you just need to understand what's going on in that market, right? Phoenix, for example, over 20% rental growth in the last year. Just insane, right? A lot of that's caused by the pandemic. It's a strong market. It's a fantastic market and I love it, but it wouldn't make sense for me to use an anomaly like that as my projections, right? Because we're going to get back to some state of normal, right? So I look at everything pre-pandemic, right? I want to kind of see what were the averages before we had this anomaly. And so, yeah, we're purchasing a property and, 5 to 7% on average pre-pandemic it was hitting that no problem. I'm still using 3% because I want to under promise, no over deliver. But on the other side is like, you can look at a different market to where unless you have the data or you're evaluating the numbers, some markets are flat, right? Like you can get into some markets where there's like 0% rental growth. Even sometimes there's negative, right? And that doesn't mean it's a dead deal. That just means you need to adjust for those risks within your underwriting by not assuming some rental growth or maybe reducing your rental growth. And it wouldn't be crazy, if it's a deal you really like, maybe it's a high cash flow deal, to maybe assume some negative rental growth, depending on where the market's been and the type of market it is in. So when you have a general rule of thumb, like just adding 3% for rental growth or, those types of things that aren't validated by anything, but they're just validated by what other people are doing, it's not a good thing to do. And that goes with like expenses too. I mean, you have discussed this quite a bit. There's some rules of thumb out there that you hear where someone says like, oh, use a 50% expense ratio. That should be good, right? That's really not that good, right? Because every market, again, is so different, right? We can have the exact same market or the property here in Arizona, and we could have the exact same property in, say, a market like Texas, right? Both fantastic markets. They're great, right? But using a 50% expense ratio may not make sense because, property taxes in Arizona and insurance is about 3 times less, right? And that's just a fixed cost, right? So you're going to kill a lot of deals by just using too many rules of thumb that are nationwide, right? You can develop your own rules of thumb within a micro market, right? Like if you're looking at Phoenix or maybe a sub market and you develop, some rules of thumb based on that specific market, that specific area. I think that's good, but you just got to be cautious, on a macro view versus a micro view.
Yeah, I just wanted to get your take on it because I knew we had talked for such a long time and it was just a great conversation. So I wanted to basically hear it again. And like you said, it's just got to be validated. And yeah, maybe you can use a rule of thumb to maybe do like the very initial pass, like pass fail on something just to kind of do a sanity check. But that's like if you're talking about sculpting a mold, that's like the first etch that you took, and then you're not even close to creating David if we're equating this to like a simile right now.
Yep.
So validating data to me is, the biggest hurdle. You want to have the freshest, most relevant data. You have to be essentially very local and in tune with what's going on in your market. You mentioned, we're looking at a big nation. There's a lot of things that could vary when you're looking at different markets. Comparing apples to apples is really apples to oranges. You mentioned CoStar a couple times. I know you guys are also local in the Arizona market. So how do you use CoStar? To what extent do you use it? And then how do you supplement that with your boots on the ground to be able to validate all of these numbers that you're seeing? Because CoStar is a great tool, but you also do have to be careful with any tool, whether it's CoStar or Reonomy or any of them, to solely rely on it. It just was one level deeper. Trust but verify. One next
Yep.
further level. So how do you take it from there?
Yeah, I love that. I'm so glad you brought that up too, because we really, like you mentioned with the sculpture, right? When you're evaluating deals, you start at this very high level and then you're constantly honing the deal in, right?
Yep.
Like even up to the day you close, right? You're always double checking. You're,
Yeah.
you're double checking rental comps. What's up renting for the area? What has changed? And you're really validating a lot of stuff as you're progressing through the deal. And even honestly, even post close, right? It's just this never ending cycle, or it should be this never ending cycle of just sharpening the pencil. You had had some quotes or some targets for your renovations, and inevitably some stuff goes over, but then you have opportunity to pivot, have some stuff come under. So it's this constant uh churn, right? And as far as the data goes, right? Like you should never just trust one source. Like this is the end all say all, right? So CoStar is good for some things, but it's actually really bad for other things, right? Like I usually don't use any like rental target numbers out of CoStar. I'll look at historical growth because that has like a backwards looking component to it with that of data that's already been aggregated. But I don't use like really future forecasts too much because no one has a crystal ball. There's some major things that I do like to look at is where have cap rates been, where's rental growth been, to kind of get a better prediction of maybe where the future could be, or at least have a data driven look at where it could be. Rental comps, I don't really use CoStar to say, hey, the rents could be this. I find that their data is very outdated. That's a lot of just, getting into your market, right? Looking at what's for rent now, calling them, see how many units are available, how quickly stuff's renting, secret shopping, rental comps. That's real time data, right? And there's other data sources too that you're going to check, and maybe they're looking at 2020 census data or 2019 older census data. That's stuff. That's information that you're going to have to go validate in other areas, right? Like housing prices. A lot of people will look at what's the median housing value in the submarket compared to the price per door that you're purchasing, just to kind of compare and contrast, right? Well, if you're looking at census data from 3 years ago, it's wildly outdated versus what's going on now. So you're probably going to want to find some more real time data for that right now. So again, it's just validating the accuracy and the how current your data is, and if it's not current enough, validating that from a different source. Yeah, it's really hard to just find one data source that's good for everything, I think.
It would probably
Uh,
be too expensive for most people anyways if it was that accurate. So
yeah, exactly. Yeah, and on the CoStar data, I think a lot of people are a little scared of the CoStar data, or they feel intimidated because it is very expensive. Like the software is very expensive. I actually don't have CoStar myself, so what you'll find is you're engaging all these brokers, right? And if you're building good relationships, you can request these reports from them, right? And of
absolutely.
course, you don't want to abuse that. You don't want to be requesting CoStar reports on properties that you're not going to buy. But if they get through your first few gates of validation, then you move on to the next step and say, hey, I'd really like to sharpen my pencil, which is the truth. Can you send me a CoStar underwriting report? They should be more than willing to do that. They almost all have access to it in just a couple minutes.
So no, that's excellent. And you mentioned, you have to essentially one notch down, verify everything that you're looking at. Um, I think any of these sources, like you say, can be very good to add kind of, a piece to that puzzle to get an idea of the story and figure out where you're going from there. But the sweat equity or this is involved to, like you said, just kind of doing the mystery shopping to see what rents are. Like once you narrow down the 3 or 4 true comps in your deal for that market, because there's probably, realistically only that many if you're actually really niching down in the submarket to really know who's comparing what tenants are comparing the properties and everything. There's probably only a handful. It's actually that's the legwork, and then you only have a few phone calls to make hopefully to get that kind of number those numbers panned out. So it does make a lot of sense to make that extra call and to get that real time data like you're talking about. Because no matter how quick these subscriptions are, usually a couple months out, and that could kill a deal for you very quickly. So,
Yeah,
you know,
definitely.
especially
Yeah.
in today's market, like you say, 20% in Arizona, it's hitting the same in a lot of other states. So, yeah, very, very important. I think on the flip side, there is some data that's a little bit more historical, like on the expense side, where stuff kind of is a little more rigid. Do you kind of use anything like for either it's CoStar or just through your PM or any kind of data more historically to kind of work with numbers that fluctuate a little bit less, if you even would call it that?
Yeah, that's actually a really great question because I think expenses is such a large component of what's
Yeah.
going on. And again, it could vary from every market. So let's say I'm looking at a deal that someone presents to me out of my normal markets, right? That I'm not looking in, not in Arizona, but maybe somewhere in the Midwest. I'm not picking on the Midwest. I'm just using an example, right? you know, So the first thing I'll do is I'll have the CoStar report pulled, and they have in there, by asset class. So whether it's a C, B, A, they have a star rating, so it's 1 through 5. But they'll break it down by asset type, asset quality, and sub market. And it'll kind of give you an idea of like, okay, what are the expenses per square foot in that sub market, right? So now you've narrowed down to a sub market, you've narrowed down to an asset class, and then you're getting some general aggregated data. But again, that is not always 100% accurate. Like none of what we're talking about should be like the gospel, right? You should
Absolutely.
always just use it, but validate it. So I'll start there and, just get a quick gut check, right? I'll look at, okay, CoStar says expenses per square foot should be around here. Their underwriting shows a different number, or maybe they match. So that give me that level of confidence on the expenses. And then I would, continue to validate that through like a T12, the historical numbers, which I think you had kind of touched on a little bit. But there's so many different resources within a sub market that you can really validate this. Maybe at a high level, you look at CoStar for an expenses per square foot. Is that good enough to kind of get to the finish line? No, it's not, right? But it could be a good starting point to kind of give you a good gut check. Next thing is you have property managers on your team, right? You should leverage them. They're managing properties of the same. So hopefully of the same size that you're purchasing, if you're picking the right property manager, they have all this data at their fingertips. Most of them could tell you right off the bat, a rough way on what your expenses per unit is or expenses per square foot. I've yet to actually find one to tell me like you should use this percentage, which is a general number that people
It's
typically
funny.
use.
It's funny they don't use that rule of thumb,
Yeah.
huh?
And they're the people who are actually in there, managing these properties, putting together the financials. So great resource. You should totally be reaching out to them. And then also leveraging that against what are you seeing on the T12? What has the property been doing? And it really just depends on the quality of the numbers or the financials that you're getting, but that's another check. So you can really combine those three and get a really strong feeling on what's going on a particular property.
Yeah, and like you say, validating the PM, and I'll just even make it a little more blanket. Just bringing in the expert when you're going to be working with these partners, literally anyways, on these deals.
Yep.
That's always the move. It's going to mitigate the most risk. Chris, you're in Arizona. I'm sure you're still learning new things about the market every day on every single deal. When you bring in the PM, they say, "Actually, we see this, Chris," and you're probably like, "Oh, good thing you brought that up because I didn't think of it because I'm seeing similar things." You think you have something nailed, you're definitely wrong because there's always something new to learn, and they definitely are the closest to the properties in the area that you could ever be. So whether it's that, the GC, anybody on the team that's going to be really doing the work, just bring them in and help them help you underwrite the deal because they're looking for business just like you are. So it's really symbiotic in that way, which is really helpful.
Exactly. Yeah, they help validate facts, and really they're the experts. The GCs are the experts of the construction, right? Like, are you gonna, is every GC gonna give you the most accurate quote? No, but you're gonna ask multiple experts in that area, right? So always validating.
Absolutely. Yeah, and then we kind of have covered more of the like broader OMs and that type of stuff. Maybe we'll just spend a few more minutes on flipping it. We talked about like raw data and how you would maybe source off market. And we won't get into sourcing, but once you get a deal, what it looks like and kind of shaping things from that side of things where it's a little bit more unrefined and you got to kind of do some more digging. Has there been anything that you found kind of helps get that process started with sellers? Because you're talking to people who have owned these properties for quite some time now, potentially. Maybe the books aren't the cleanest. Maybe, not everything's up to speed. So you kind of, whether it's like the top 10 things you need from a checklist to get from them, or what are the kind of big to-dos that really help you shorten the gap to learn the most about the property in the quickest amount of time?
Yeah, that's a really good question, and it's gonna depend, like most things, right?
Of course.
It's gonna depend on the level of the detail of the financials of the seller, right? And a lot of times when you're reaching out to sellers directly, maybe you give a little phone call and say, "Hey, your asset fits what we're looking for. We're looking to expand," right? So most of the time, they're not just like, "Okay, yeah, give me your email. I'm gonna send you all the financials you need," right? The most common responses are like, "No, don't ever contact me again," or "We're not quite ready yet," or what's your price, right? And none of them are very helpful. So you got to kind of work backwards. And in the most ideal situation, with that seller, you would get, the rent roll and the T12 are the best places to start, right? Because then you can start looking at what's been going on historically, where the current rent's at. And then you can leverage your property manager or your own research to kind of really figure out, okay, this is where the property's at. Is it underperforming? Where can we take it to? And you can really put together a good basis of an offer, or at least the start of an LOI, to them before you collect even more information, right? Um, if you don't have that data, right, you can work backwards even further. Let's say, reach out to a seller and they say, okay, well, yeah, I don't know you and I'm not going to send you financials for my property. I'm not going to send you a rent roll. I'm not going to send you a T12. I need you to just let me know where you're at. Cause if you're not even close, I'm not going to have this discussion. And it's pretty, you got to take it from their point of view, right? That's a reasonable response.
Yep.
So then, you kind of work backwards and say, okay, I can't get everything right now, but I can kind of work towards, is this a deal? So, of course, asking, hey, what's your price? Or do you have a price in mind? That's a good place to start because you'll know pretty quickly if it's realistic or not, or if it's within striking distance. And then, if they're not wanting to do financials, you can just say, hey, I just want to validate what are the unit mixes. And can you just tell me about what the average rents are in place for each unit mix, right? And then from that, you can use a lot of the sources that we've already talked about to kind of build out what your potential expenses should be for that property. Working with your PM and saying, hey, we're looking at this 50 unit property. It's in this submarket. This is the age. Here's some pictures of the property. If you can get some Google Street Views, if you want to do a quick analysis or go drive by, and you could tell a lot by looking at a property on the condition it's likely in, right? And then you can really work backwards from there and then get back to the seller and say, hey, I really don't have a lot of information right now, but based on what you're telling me, I think I can be in this range based on the data you validated with your property manager, going on site, or even just other online resources. And you can really get pretty close. And honestly, like when you're looking at, hey, broker's PM, you're really doing a lot of this stuff anyways, because if you're
Exactly.
trusting everything that's in there from a broker, you're doing something wrong. You need to validate all of that too, right? I know they're professionals in the field, but we also got to remember they're also salespeople. They have something to gain from the sale of the property. You'll see a lot of times expenses will be understated, cap rates will be wildly overstated. So, all of this really applies to whether you're talking to a broker, a direct to seller, another syndicator, for an LP opportunity or a partnership opportunity. You should really be validating all of these things anyways.
I think the interesting piece to take away from the off market bit, Chris, is kind of the working with the seller. It sounds like for you guys, the success has been doing as much of the legwork up front, not getting as little of the information from the seller, but not pestering a seller who you are kind of forming a relationship with to give up kind of all their information, which it's sensitive data and they probably own the property for a long time, not really willing to give that up yet. But once you kind of do your legwork, give them at least some ballpark of an offer. They can kind of see you're a serious player looking to actually do a deal and not just kind of kicking a tire. So I think that probably helps to kind of move the wickets along, and then it creates that worker relationship. I think that's the biggest takeaway from that whole process to me.
Yeah, exactly. And I think you do want to present yourself in, a credible and sophisticated way, right? You want to, when you get back to them, you can say, hey, I really appreciate it. And you think from their standpoint. We already talked about this, but you're asking for all their financials for their property, right? Some guy who just called them, they don't
Who?
know who you are. Yeah. Yeah. So I mean, you gotta, you wanted to let them know that. You say, hey, I understand it's kind of a strange request, but to give you the most accurate offer, I need all this information, but I understand if you're not willing to, kind of get to their level, right? Like level with them and then work backwards. And that's going to build a lot of trust. And then they can get you the financials when you guys are ready, or if you're even in the realm of possibility. And a lot of times you might find that, maybe they're really unrealistic with their number too. You know what I mean? And you still end up on a good relationship. And then you follow up with them in a few months. You say, hey, I really appreciate it. It's not something that works for me right now. We'll reconnect and see if anything changed in like 3 to 6 months.
No, excellently put. And Chris, just to kind of sum up the whole show before we get into the 5 key questions, it's validate, validate, validate. All of this stuff is, whether it's raw or polished data, it's got to be trusted, but it's got to be verified. So you got to make sure that you're doing your due diligence, because if you're gonna make some assumptions, they better be conservative. And if you, on the flip side, if you just trust old data and it's too conservative, you're never gonna get anything done. So you got to really just nail the market and know what you're looking at. Present day. So that's a key takeaway. But yeah, unless you have anything else to add, I'd love to get into these 5 key questions.
Yeah, I would just tag on what you said. Like the phrase "trust through verification" is one of my favorite ones. Right? Like it's like that's really what you're doing. You trust through verification, and then you build relationships. And like I said, you get the green check mark for a lot of these assumptions are being made, and then you really naturally build this relationship, and you don't have to be so intense about it, right? But
Yep.
in the beginning, you want to understand this. You're taking people's money and you're putting it into the deals, right? You want to be responsible.
Absolutely. Yeah, I couldn't agree more, Chris. And yeah, let's just hit these 5 key questions while I got you. The first one here, if you could only pick one trait that explains your success, what is that trait and why?
I would say for me, as I'm a very detail oriented person, if you can tell, I'm very into like, again, validating facts, verifying assumptions, even my own. When I'm doing something, I like to consciously think, okay, why am I doing this, and what's supporting the assumptions that I'm making?
Yeah, I think that's why we get along so well. We had quite a good first, in person kind of chat at the Sarasota event a little while ago. So we were
Yeah,
definitely essentially
very
nerding out
similar.
for all this stuff for about 20 minutes, and then the night had to end. But yeah, yeah,
Yeah.
couldn't agree with you more there. And then what is the most uncharacteristic trait, um, uncharacteristic thing, sorry, you have done in your business, Chris, and why did you do it?
Yeah, as odd as this may sound, when we got started getting into that, because we were originally buying properties ourselves, right? But then we got into the syndication space. I would say it was actually raising capital, right? It was this awkward feeling of like feeling like I was a salesperson or pitching a deal, right? And really how I overcame that is I just kind of backed up and said, okay, what I have here is an opportunity that I'm going to put my own money into. That's how much I believe in it, right? I'm providing an opportunity, and that if that draws people in and they want to join us, I'd love to have people on because I want to help them advance too. So I kind of spun it as like I'm not selling a deal, right? I never like give a hard sale on a deal or a pitch or anything like that. It's like, hey, here are the facts, here's the deal, the opportunity. Love to have you on board. If this isn't the one, I understand, and let's just keep in touch. So yeah, it's kind of switching that mindset to an opportunity versus a sales pitch.
Yeah, and I'm sure you'll agree. You find much more when you're not looking for money, if you will, kind of like you said. Like that screams like need versus like you said, it's an opportunity. You're not trying to be pushy. You're trying to invite people to invest with you. It's quite a different business proposition than hey, we're
Yeah,
looking for capital. Please invest. That doesn't make anyone sit well. So
yeah. Don't want to be in that
yeah,
position for
yeah,
sure.
absolutely. And then, Chris, can you name a time where you felt like you were not going to end up successful, and how did you overcome that fear?
It's kind of along the same lines as the raising of the capital, right? I kind of had this discomfort around raising capital or bringing people on, bringing other people's money on because it is such a huge responsibility, right? Like if I lose money, is it going to be the end of my world? No. But the other people who are passively investing, they're investing significant amounts of money for themselves. And it's like you have the responsibility to protect their money. Right. So it made me a little bit nervous. So going into our first capital raise on our first deal, you always have a thought on, okay, well, I have this base of investors. I know people who really trust me, who want to invest with me. And you have this target capital raise, right? So before you have a deal, it's like, oh yeah, I feel really good about this. But when it gets down to, okay, now we need to raise some money on the deal, that's a whole different story. So I kind of felt a little bit of reserved and like, okay, so I kind of think I could, get the capital raised. And then you just got to kind of get into it again, lay out all the facts, present it as an opportunity. And we raised all the capital in just a couple of days. It went really smooth. But when you get into it, you just don't know, right? Like a lot of people will talk about wanting to invest, but until you actually close out the deal and wire in the funds, it's just so different.
Yeah, and I think, man, I think that's a healthy fear. Like, if that goes away completely for me, I'm gonna maybe have to take a check on myself. But like, if you're a good investor, you should have like a healthy level of fear for that when you start raising funds for your first or 100th deal, at least in my opinion.
Yeah.
Maybe don't lose hours of sleep every single time, but definitely, making sure that you feel that in your gut, whether it's kind of similar to like the public speaking or whatever else. it's a healthy fear, I think. So it's definitely good to have.
Yeah, I agree with you. And I think a lot of people probably have it, the
Yep, I
first
think
go
so too.
around, so,
Yep.
but they should.
Yeah, definitely think they should.
Yeah.
And then pretty much flip to that. Can you name a time where something in your business went perfectly, and what did you do to make that a reality?
So kind of on the opposite side is like everything we talked about validating facts and really laying out a good business plan and being conservative, like actually being conservative. Everyone says they're conservative, but you can only tell if you're conservative by checking that against something, right? Like facts, not opinion. So we did that on the deal that we closed, the one that we raised capital on. And man, we just nailed that deal. We exceeded expectations in almost every area. We like beat 5-year returns by 2 times within like the first year, and it just went really well. Were there challenges within the deal? Of course, right? But we were on top of it. We pivoted always, again, like we had mentioned, church, like when you close a deal, the work doesn't stop there. You're still validating stuff. You're checking your budgets, you're validating things, and you're adjusting. So actually, all of the legwork you do upfront to validate facts, to be conservative and really lay out a good, clean business plan, it really pays off when you get to closing.
Yeah, like we mentioned, if you're relying on one business plan that's pretty rigid, it's going to be hard to execute. But if you have a lot of margin or a healthy amount of margin, and you can kind of navigate the waters, and obviously, when you write a conservative deal and you can capture a great property like that one and do a 2x in under 5 is just always a good day. That's probably
Yeah.
flipping to the opposite of the fear of the raise, and that's we just talked about it before the show. You got a great day coming up this week to start the sale process and get the money back to your investors. That's a fun day right there. So
Yeah, exactly. That's the
yeah,
fun stuff. Yeah.
yeah. No, that's awesome. And then last one here, Chris. What have you been focusing on lately to improve yourself or your business?
Yeah, a lot of what we're kind of talking about here too is like everything is a constant level of refinement. You had mentioned it already. Like you're still, even in the Phoenix market, you're constantly learning different things through your PMs or through deal evaluation, but really getting even more systematic within my business. Whether that's through, when investors join us or sourcing deals and really having a good system built out to, okay, how do we handle this flow through our business and systemize it? Bringing on an assistant was a big help. She kind of helps a lot in the kind of the day-to-day and execution of those flows, but really kind of taking a step back out and getting systematic on it so you can hand that off. Certain portions of that off has been really a big help lately.
No, that's amazing, Chris. I appreciate you joining me today. I know we covered a lot, and this is, the very, like you said, detail oriented show. I love these shows. It's my favorite type of show, whether it's this or the mindset stuff are usually my favorite types of shows to cover. Evolve Equity. Do you want to just plug where they can reach you? I'm sure the website, but do you have anything else you want to mention? Go right ahead.
Yeah, Dave, no, I really appreciate you having me on the show. These are the conversations I love having. Like I said, me and you met in person and, we were just chatting about this for a while. We probably could have done it for hours. There's so many dynamics. I really appreciate you having me on. If people want to reach out to me, Chris at Evolve Equity, or just go to evolveequity.com. We have some information on there. And again, I really appreciate you having me on, Dave.
Yeah, much appreciated, Chris. Thanks again.
Thanks.
Thank you for listening to the show. I don't take your time and attention for granted and appreciate that you would spend it with me. If you enjoyed this show or any of my previous shows, it would be a huge help if you would rate and review the show on Apple Podcasts or your favorite podcasting service, or even just share the episode with a friend. And if you'd like help from me or would like to talk about real estate investing further, feel free to visit the show notes for more information, or you can visit davidtravis.com.